Barrera with the Investing News Network, and here with me today is Adrian Day of Adrian Day Asset Management. Adrian, thank you so much for joining us today.
Thank you for having me.
All right, so we're here at the start of 2019 at the BRIC conference. My first question for you today is, how are you feeling about gold for 2019?
I'm feeling very positive. I think we've had a good run, obviously, since middle of November, and in fact it's up since the middle of August. We've had a good run. There's a few things that could happen that would be positive for the world, negative for gold. It could give us pause in the short term. If the US government shutdown issue gets solved, if the China trade, if there's an agreement on China trade, for example, we could see gold pull back a little bit. But beyond that, I'm very, very bullish on gold. I think, all of the things that we've seen over the last few years that have held gold back have one by one been turning. And most recently, of course, is the stock market. When financial assets are doing well, as they did for the last, 6 years, 7 years, people feel they don't need gold. But with the increased volatility, particularly volatility to the downside, but just volatility generally, people start to get nervous and they feel they need a hedge in their portfolio. So the one last remaining sort of central, as it were, domino to fall really would be the dollar. We need a weaker dollar to really get gold going, I think. But as we've seen in the last 6 months, gold can do reasonably well, even if the dollar is reasonably strong. So I'm very bullish.
That's good. And what about the stocks market? Do you think stocks are going to perform better this year?
The gold stocks or gold stocks?
Yes.
Well, of course, as we all know, just to set the framework, as we all know, by and large, the gold stocks have really lagged gold up until the last 6 weeks, really. If you look at a graph of last year, you saw gold outperform the S&P, well outperformed global markets, and towards the end of the year, the gold stocks started to outperform gold. And that is the normal pattern you would expect. You would expect gold to move first, and once the gold move is firmly established, then the stocks start to move. The seniors start to move first, obviously. And so a lot of the stocks that the juniors that we all love and own haven't really moved yet. But that's the sort of next step. As we see gold will probably bounce against the 1300 2 or 3 times, normally does, or on these round numbers. But once gold breaks out above 1300, I think you're going to start seeing some of the juniors begin to move. And there's some very good values among the juniors.
All right, and one of the biggest news so far this year has been the Newmont Goldcorp deal. What are your thoughts on that, and are we going to see more M&A activity in 2019?
My thoughts on the Goldcorp Newmont deal. Do I have to be polite?
You can give your opinion, your honest opinion to our audience.
Will you beat me? To be honest with you, I'm pretty disgusted looking at it as a Goldcorp shareholder. Mm-hmm. Goldcorp is essentially selling itself at a price that we haven't seen since early 2002. We are selling in a stock at a 16-year low in price. That says one of two things to me. It says that either management think that this deterioration in price is going to continue. Goldcorp was $60 in 2013. It's now $9 US dollar terms. So either management thinks we're better sell this pig while we can before it goes lower, or else management is looking at its severance, change of control, severance pay, and saying, let's just get rid of this thing and take our pay. I'm pretty disgusted, frankly. Anytime you see a company selling itself at a 16-year low price, that is a bad sign. From Newmont's point of view, they are picking up a bunch of assets, which fills in their pipeline and diversifies their asset base quite a lot. A lot of Latin America, which Newmont doesn't have, and so on. So it diversifies assets, and it gives them the opportunity we know they're going to diversify, to sell off some of the assets, They haven't said which yet, but it gives them quite a bit of flexibility in selling either their own assets or Newmont's or Goldcorp's assets to bring down the cost of this deal and reduce the debt that they're taking on from Goldcorp. So from their point of view, it's not a bad deal, and they're picking up some reasonable mines. Now, what it means for the market as a whole, will we see more? Well, we've just had 4 of the largest mining companies merge. I don't think either of those is going to be doing anything big in the near term. So then you're looking at the next group. I think we'll probably see a bit of a pause in the near term, frankly, although we may see some mergers of the mid-tier or the less than senior producers. We may see some activity among them, but I think among the big companies, we've probably seen it for a little while.
All right, and here at BRIC, you're going to be talking about the consequences of QE and tightening for gold. Can you briefly share some thoughts on that?
Briefly. Well, QE, quantitative easing, which was basically an experiment by the Federal Reserve and global central banks, did things that were totally unprecedented in terms of their scale. They cut interest rates in the terms of the Fed to all-time historic lows, and by all-time I mean lows that go back to 3,000 years BC. These are long-term historic lows, and in the case of Europe, Japan, and many other areas in the world, to negative rates. In other words, you lend me money, and I guarantee I'll give you less back. So this is unprecedented. They also, of course, exploded the balance sheet. And that had certain consequences. One of the consequences was that it gave a huge boost to the stock market. Now, if we start to undo that, do we honestly think that we won't have significant consequences in the other direction? So as the Federal Reserve, last October was the first month since the crisis in 2008 where you had net withdrawals of funds by global central banks. Central banks on balance withdrew money from the system rather than added. And that coincides with when the market started to wobble. So if the Fed is going to do what it says, which I don't think they will, but if the Fed is going to, on balance, tighten, Europe has already said they're not buying any more assets, and starting in the spring they're going to start selling assets. As central banks start tightening, that's going to have a significant negative effect on the stock market. And then I think the Fed will, which it already has indicated, will pause for a while, right? When the Fed and central banks pause, that is very, very positive for gold, because it indicates that the central banks can't do what they want to do. And that is very, very positive for gold. That was brief.
Thank you. And moving away from gold, are there any other commodities you're watching this year?
Yeah, I'm still very bullish on copper. The copper price is low. But the big thing about copper, the two things to remember about copper, number one, major, big copper deposits are extremely rare. If you look at a list of the top 10 copper deposits by reserves and the top 10 copper producers by production, not a single mine has been added to either of those lists this millennium. So despite the bull market in copper, despite the super cycle with China buying, despite the huge increase in spending by global copper companies, we haven't found a deposit that gets into the top 10. Most of the mines in the top 10 are over 100 years old. So that's number one. Very, very rare to find a major mine. Grasberg, Freeport's Grasberg in 1988 is the last major mine to be discovered. Oyu Tolgoi is a major mine, but it's not in the top 10. That's number one. Number two is it takes a long time from discovery to production, but it also takes a long time from the go-ahead of development into production. Freeport has put on hold all new mine production. Other than mines are already in development, they're not developing any new mines at the moment. Freeport says that from the time they give a go-ahead to a new mine, it's a minimum of 6 years before it produces. This is a mine that has already been explored, built up, the reserves are there. It's shovel-ready, as he put it. But a shovel-ready deposit still takes 6 years before it produces. So we're going to go through a phase, as always happens, when the price starts to move up, production starts to go down, and then there's a scramble to put new mines into production, but it takes 5 or 6 years before that production hits. So we have a period of, 4 or 5 years when prices are going to be very strong.
All right, and in 2019, this year, what would be your best suggestion for investors interested in the junior mining space?
That's difficult because there's an awful lot of good companies out there. Let me search my mind. Evrim would be one. Evrim, of course, had very disappointing results on the Quale deposit. The stock fell off, 70%. But if you look at it where it is now, the cash they have on the balance sheet and the value of one royalty that they own on Ermitaño is more than the entire market cap. So everything else in the company is free, and they have lots of exploration property, they have lots of joint ventures, and they have regional alliances with good companies. So, to get all that free, essentially, is a good deal. And very good quality people, high quality people. And one thing to say, when a company has failure, as they have so far at Quale, and Quale is not over, but when they have failure, it's interesting to look at how they handled it. And the disclosure from Evrim all the way along, I think, has been class act. They never over-promoted the project, and they were fully upfront when the results didn't match their hopes and expectations. Second one would be Metalla. I'll be brief now. I know we're running out of time. I always talk too much because I get excited about companies. Metalla is a junior royalty company. It's only been in existence 2.5 years. They've already got 4 different producing royalties, plus a pipeline of about 14 royalties from exploration through to near-term development. Good balance sheet, and they pay a dividend. The stock is trading around 80 cents, and the dividend's 2.3%. So in today's environment, that's a healthy dividend to be paying. But I think the company, as the company grows and adds more royalties and diversifies its producing base, you're going to start seeing a re-rating on the company towards the valuation of the more senior royalty companies. I like some of the smaller prospect generators. A company like Riverside, for example, good management. They preserve the balance sheet. They're very, I won't say cheap, but they're very frugal with spending money. They've got some good projects available for joint venturing. They probably have to raise money soon. So when you see them announce the financing, see if the stock comes off at all, and that would be a great time to be buying.
Right.
If you're a long-term, patient investor.
Thank you so much for joining us today.
Thank you.
Once again, I'm Priscilla Barrera with the Investing News Network, and here with me today is Adrian Day of Adrian Day Asset Management.